All right. Getting harder and harder every time now. Okay. Market update. What we're looking at right now is just the different sectors and how they performed over the last 3 months. So it's the basic sector. As you can see, it's come down quite a bit, but positive. I think everything is positive. Cyclical comes down. Yeah, consumer defensive has come down. Energy has come down. Even the banks. But it looks like the banks are doing better than everyone else, though. And look at this. Look at the health sector. I mean, this is the health sector in total. Like that's crazy. And that just goes back to what I was talking about with Merck and just the difficulty of finding, that great company within the health sector. For a very long time and still, I think a little bit today, the health sector has been a part of speculation. There's a lot of traders in there, and not necessarily just traders, but like speculators. People looking to find that stock that's gonna, pop for 1,000%, right? Because what happens is you get this company that's researching this one drug. That one drug happens to work. Next thing you know, they're getting bought out by, some big guy, or maybe they somehow get a contract to start, selling this medicine to the open market, and the price just skyrockets. It goes crazy. And for a long time, that's always been the thing. It's the bio medicine or biomedical industry. And so, because we're dealing with these huge behemoths of health companies, these are not necessarily the small guys that are, coming up with the brand new exciting drugs, but they're actually buying these smaller companies that have that research. And they still do their own medical research. They still do, try to find their own drugs and stuff like that. But man, it's just it's not great. Not great at all. All right, so industrials came down a little bit. Real estate, interesting. It's on par with the banks. I wouldn't expect that. Tech, kind of a mixed bag. I would have to go back and look at last few months in tech to really see what's going on there. And then utilities, kind of hard to say. I say again, maybe a mixed bag, or maybe utilities have even come up some. March, we're actually talking about the month of February, and I believe it was February where we had that huge winter storm, right? And so I can imagine why February would be down, and then we'll have a kind of a rise from there. All right, so let's take a look at performance. There we go. So our heat chart. Um, Once again, I don't think it's a surprise, but the beta portfolio not doing so great. Remember, beta is companies that perform well when the market is down. Okay, and so I think we've seen over and over and over again that right now the market favors those companies that are actually putting up returns, and so that's kind of what's winning right now. Last month, the Alpha portfolio beat out everybody with a 9% return. This month, I'm not sure, and I'll tell you, I'm actually really excited about doing this. I purposely held off looking at this stuff in preparation for the video. I had to come in here and, of course, update it, but I did not look at everything just so that I could see it with fresh eyes. So I'm really curious. as to what portfolio outperformed because, oh, look at that way down here. Dividend, beta, and M score. That is a weird one. Doesn't happen often. But it's not far away. That's for, oh, wait a minute. Oh, I know what's going on. 36, this is 35. This is how the sausage is made. It's always something. I think I can just do this straight so I can at least get an indicator. All right, let's see. Maybe the indicator was down there. Let's see. There we go. Oh, yeah, okay. So again, yeah, Alpha again beat out everybody. So let's take a look at Able. No, there we go. What is this? This is all time. Oh my goodness, 50% since 2018. Alpha down, up moves, Alpha. The return portfolio is falling. You know, in previous videos, the return portfolios were further up, and now we're seeing more Alpha. That's really interesting. So let's see what the rolling past 12 months up moves. Yeah, it's nothing but up moves here. There's only one return in the bunch. And so what that shows you is that the market is starting to change, which makes sense because it is changing. You know, we're seeing it. And let's just check volatility here. So of course, you know, beta's going to be the best. They're not going to lose as much, right? And then alpha and return. And so I imagine both of those guys are going to be here as well. And it looks like, no, again, the return portfolio is falling behind alpha. And so what that means is that we need to come in here and take a look at what an alpha portfolio looks like. All right. Now we're currently following the return portfolio. Which is here. And, you know, one thing that I did mention in the previous video is that Bank of America is no longer investable. And that may have a lot to do with why the return portfolio has changed so much in performance, because what happens is what this software does is that once Bank of America is no longer investable, it takes Bank of America completely out of the equation, right? And it just pretends that Bank of America has never existed, and it replaces it with the next company, and it assumes that this company was purchased back in 2018. Okay, and so it changes the performance completely of the portfolio. But that's important though, because like I said, Bank of America is not investable. We cannot invest in Bank of America. We have to move on from that. So we're going to take a look at this AMTD as well as what other bank is there in our in our basket to look at. All right, so just taking a look here. So SYY, BIP, we talked about that. UDR. Okay, everything else except for Garmin and Hewlett Packard. All of those. All right, so let's take a look at the alpha, which is all right. Now, this is actually really cool. I'm actually really happy to see this because a lot of these companies we have already in our return portfolio. So just really quick, alpha are companies that perform well when the market is performing well. All right. And so we're already in Best Buy. Blackstone has always been a great company, great dividend. We got out of Blackstone to get into Bank of America, and so I would love to get back into Blackstone. Valero, we're in that one. Fastenal, we're in that one. GLW is a new one for me. RTX, we've talked about those guys. Raytheon. LYB, we talked about them a little bit. Merck, BXP, I don't know much about. Rogers, of course, and then PEG for the utility. So, honestly, I don't know how much of this change is because Bank of America is out of the equation, or um, whether or not, you know, we are really seeing a change in the market. I can say this. Um, Based on the performance that we saw here in our table, right? We know that these sectors are turning down. We see it. It's very simple. You know, real estate and banking are basically on par. Everything else is like less than 2%, right? And it's been 3-4% previous months. And so what that tells me is that the market is clearly declining. All right. Now, if the market is declining, okay, and the alpha portfolio is companies that perform well when the market performs well, um, then that doesn't mean that the alpha portfolio is necessarily performing better than the return portfolio. It just means that once you take Bank of America out of the equation, um, the alpha portfolio performs better. Okay, and the fact that we pretty much um, have the same companies for the most part. You know, there are some stark differences here, obviously, but for the most part, I mean, a lot of these companies we already have. You know, so I'm gonna go and say that there's no need for us to change direction. However, it is important to note that the end of our fiscal year is June, and so on July 1st, we will have a brand new basket of stocks. Brand new basket of stocks. It's very possible that Bank of America will no longer be in that basket of stocks, and we will also be choosing a brand new direction and portfolio based on that new basket of stocks. Who knows what it's going to be? You know, it's going to instead of looking at um, historical performance from 2018 forward, it's going to be looking at historical performance from 2019 forward. And so, you know, when you think about, you know, what was happening in 2018 versus what was happening in 2019, that's also going to change how those numbers and how those companies are analyzed. And so, you know, it'll be interesting to see. I think the biggest change is going to be the COVID drop, right? The COVID drop was not part of something I would actually um, want to take a look at. I don't know if I can quickly see. Yeah, it's not gonna let me blow it up. So yeah, 2016 to 20. Yeah, so it was not part of that COVID drop, and so we'll be looking at 2017 now. It'll be 7 2017 to June 2020. So so the COVID drop is going to definitely be there. And so I imagine you're probably going to see either the companies that benefited from COVID um, somehow um, getting placed into some portfolio for one reason or another, or you're going to see possibly a lot of the beta, um, um, companies or the beta portfolio performing best. So it'll be really interesting to see, and I'm excited about it. So anyway, so that's that. So the alpha portfolio definitely performing better than the return portfolio, and that's simply because Bank of America is no longer in the story. But we're going to stick where we are with the return portfolio. But the one thing that we will take a hard look at is AMTD, and I want to look at Hewlett Packard. We've talked a lot about the BIP. I mean, Excel Energy is doing well for us, and the South American holdings, I'm still iffy on it, but something we'll take a look at again for sure. We can't move out of anything else really. Real estate, we don't have a sell signal on yet. Um, so yeah, so Garmin, we can take a look at, and then AMTD, we can definitely take a look at.